Imagine waking up on a Monday morning. The alarm didn't go off because you didn't set one. You aren't rushing to beat the traffic. You aren't dreading a meeting with your boss. And you aren't counting the days until the weekend. Instead, you check your phone and see a notification. Payment received. While you were sleeping, your money was working. Picture a world where financial freedom isn't just a buzzword used by influencers, but a tangible, mathematical reality sitting in your brokerage account. This is the dream we are all sold. But for most people, it remains just that, a dream. Why? Because the traditional path to get there is broken. If you go to a typical financial planner, they will tell you the same old story. Save 10% of your paycheck, buy a low-risk index fund, and maybe, just maybe, when you are 65, you can retire. But what if you don't want to wait until you are 65? What if you want your freedom while you still have the energy to enjoy it? Today, we are going to break the rules. We are going to build a custom roadmap for our friend Mark. Mark is tired of the grind. He has a specific number in his head, $2,850 a month. That is $34,200 a year of pure passive income. It's enough to cover his mortgage, his groceries, his utilities, and maybe a few nice dinners out. It is the price of his freedom. In this video, I'm going to show you and Mark the income first strategy. We are going to explore 3 specific asset classes that are designed to print cash today, not just 40 years from now. I'll show you why the 4% rule is outdated for people like Mark. And in the end, I will show you a detailed year-by-year projection of how Mark can turn a modest weekly investment into a multi-million-dollar income machine. Before we dive into the solution, we have to understand the problem. Why hasn't Mark retired yet? It's not because he isn't working hard. It's because he is fighting a losing battle against the math of traditional investing. Let's look at the numbers. The S&P 500 is a great wealth builder, but it is a terrible income generator. On average, it pays a dividend yield of about 1.5%. Now, stick with me here, because this calculation is crucial. If Mark wants to earn $34,200 a year, and he relies on a 1.5% yield, do you know how much capital he needs? He needs $2,280,000. That is a mountain. For the average person, saving $2.3 million takes a lifetime, if it happens at all. When Mark sees that number, he gets discouraged. He gives up. He thinks freedom is impossible. But what if we change the variable? What if, instead of accepting 1.5%, Mark targeted assets that pay 7%, 8%, or even 10%? Suddenly, the math changes completely. At a 9% yield, that mountain shrinks from $2.3 million down to just $380,000. That is still a lot of money, but it is achievable. It is a target Mark can actually hit in 5 to 10 years, not 40. This is the power of income investing. So, where does Mark find these yields? He can't just pick risky stocks and hope for the best. He needs a system. He needs the 3 pillars of passive income. The first pillar of Mark's new portfolio is real estate. But hold on, I am not telling Mark to go out and buy a duplex. Being a landlord is hard work. You have to fix leaky toilets, deal with bad tenants, and pay property taxes. That is not passive income. That is a second job. Mark wants to be a digital landlord. He is going to use real estate investment trusts, or REITs. These are companies that own the infrastructure of the modern economy. We aren't just talking about apartments. We are talking about data centers that power the internet, cell towers that carry our phone signals, and warehouses that store our online orders. These companies are landlords to the biggest tenants in the world, companies like Amazon, Google, and AT&T. And here is the secret sauce. By law, these REITs must pay out 90% of their taxable income to shareholders like Mark. They are essentially pass-through vehicles for rent checks. For Mark's portfolio, we are looking at high-quality REITs like Realty Income or perhaps VICI Properties, which owns casinos and experiential real estate. These stocks typically offer yields in the 5% to 7% range. More importantly, many of them raise their rents every single year, which means Mark's income keeps up with inflation. Let's apply this to Mark's goal. If Mark wanted to get just $1,000 of his monthly income from this pillar, he would need to invest roughly $185,000 at a 6.5% yield. It gives him the stability of real estate without ever having to answer a phone call from a tenant. But Mark is impatient. Real estate is solid, but 6% might be too slow for him. He wants to speed this process up. This brings us to Pillar 2, the cash flow engine. We are talking about option income ETFs, also known as covered call funds. This is a strategy that used to be reserved for sophisticated hedge fund managers, but now it is available to Mark with the click of a button. Here is how it works in simple terms. Imagine Mark buys a stock. He hopes it goes up, but with these funds, the fund manager buys the stock and then rents out the upside potential to other traders by selling call options. In exchange for capping the potential growth, the fund receives a massive, steady stream of cash premiums. These premiums are passed directly to Mark. We are seeing funds like JPQ or SPYI consistently delivering yields of 10%, 11%, or even 12%. This is the turbocharger in Mark's car. If Mark puts money here at an 11% yield, every $10,000 he invests generates roughly $91 a month in pure cash. To generate another $1,000 of his monthly goal from this pillar, he only needs about $109,000. Notice the difference? Compared to the REITs, he needs significantly less capital to get the same income. However, there is no free lunch. The trade-off is that these funds won't grow as much in share price. They are pure income machines. Now, if Mark stops here, he has a problem. $2,850 buys a comfortable life today. But in 10 years, thanks to inflation, that same amount might only buy half as much groceries. Mark doesn't just need income, he needs a raise. That is why Pillar 3 is non-negotiable, dividend growth investing. Here, Mark invests in companies that have raised their dividend payouts for 25, 40, or even 50 years in a row. We call them the dividend aristocrats. Companies like Lowe's, Target, or Johnson & Johnson. These companies might only pay a 3% yield today. But here is the magic. They increase that payout by 5% or 8% every single year. Think of it like a snowball rolling down a hill. In year 1, the snowball is small, but as it rolls, it picks up more snow. In 10 years, the yield on Mark's original investment, what we call the yield on cost, could be double digits. This pillar is Mark's insurance policy. It ensures that when he is an old man, his passive income has grown enough to cover his rising medical bills and living expenses. So, we have our 3 pillars. Now, let's build the master plan. Mark decides to be aggressive. He wants freedom fast. He creates a hybrid portfolio that is 40% high-yield covered calls for immediate cash, 40% REITs for stability, and 20% dividend growth for the future. This gives him a blended average yield of roughly 8%. Mark commits to investing $500 a week. That is $2,000 a month. And crucially, he turns on DRIP, the Dividend Reinvestment Plan. Every penny of profit buys more shares. Phase 1, the grind, years 1 to 5. The first few years are the hardest. Mark is putting in $2,000 a month, but the dividends feel small. At the end of year 1, he is only earning about $140 a month. It barely covers his internet bill. Most people quit here. They say, this isn't working. But Mark sticks to the plan. By year 5, he has invested $120,000 of his own cash. But his portfolio balance is now $150,000. And his passive income, it is now $1,000 a month. He has officially covered his biggest expense, his rent or mortgage. The snowball is moving. Phase 2, the tipping point, years 5 to 10. Now, the magic of compound interest really kicks in. The dividends are now buying huge chunks of new shares every month. By year 10, Mark's portfolio has grown to nearly $375,000. He is now generating $2,500 a month. He is agonizingly close to his goal. He can see the finish line. Phase 3, financial freedom, year 11. It happens in year 11. Mark's portfolio crosses the $430,000 mark. His monthly passive income hits $2,860. He has done it. He has replaced his necessary expenses. He didn't need $2.3 million. He didn't need to work for 40 years. He did it in just over a decade, with less than $500,000. Phase 4, the legacy, year 20. But let's say Mark loves the game. He keeps the money invested. By year 20, that consistent $500 a week habit has turned into a portfolio worth $1.1 million. And his monthly income? A staggering $7,400 a month. Mark is now wealthy. He has created a legacy that will pay his children and grandchildren long after he is gone. The difference between Mark and everyone else wasn't luck. It wasn't finding the next Bitcoin. It was simple math. Mark understood that he didn't need to climb the $2 million mountain. He just needed the right vehicle, a high-yield income engine, to get him to his destination faster. Financial freedom is not about being the richest person in the graveyard. It is about buying back your time while you are young enough to use it. So, take a moment to picture your future, visualize the life you want to lead, and then let the numbers guide you. Now, you might be asking, okay, but which exact ETFs should I buy for Pillar 2? I have done the heavy lifting for you. I've analyzed the top monthly dividend ETFs for this year. Click the video on your screen right now, where I break down the top 5 funds that can jumpstart your income journey today. I'll see you there.